Chris Whalen, chairman of Whalen Global Advisors, author of The Institutional Risk Analyst, an independent analyst, a Wall Street banker, a friend of this show. It is great to welcome you back on and great to see you. We look forward to it every month.
Happy. I hope you had a fine turkey day. We had 5 days of house guests.
I certainly did. I did all the cooking. I got to say, I did all of the cooking, so I'm exhausted. But it was fun. That's my passion. And I'm sitting here in New York, and at some point we got to get you in studio, Chris. And I know it's going to happen in the new year. Yeah. Well, it's great to see you again. And the last time we had you on was the day before the election. Gosh, it seems like time just flies by. So let's start where we always start, Chris. And that's that big picture, that macro view where we are today. And as you know, Chris, you can take all the time you need to set the table.
Well, we're kind of post-election, obviously, and President-elect Trump is picking his cabinet. Not so bad. I think Scott Bessent for Treasury is a good pick. We have a very interesting young man who's been nominated for HUD, for housing. Former congressman, actually seems to know something about the industry, NFL player, really interesting guy. So I like a lot of these appointments so far. The Fed is kind of going sideways. We have, as usual, contradictory data. There are a number of governors who said we should wait. So I'm not really sure what they're going to do in December. I'm not sure that Powell has a consensus for another quarter point, and he kind of likes consensus. So, that's really where we are. The markets are waiting to see what happens, because if we don't get another rate cut, then the whole narrative has got to be reworked for 2025. Mortgage rates are up around 6 7/8, 7, if you want to make money. We just put out a piece about the prospective release of Fannie and Freddie from captivity. So, it's quiet, thank God. The French government's about to slide down the dumper. Their debt is trading outside of Greece right now. The problem is Macron, the president, called an election and he didn't win. So you've got a 3-way tie now, and they can't do anything. They can't pass a budget. I think there's a good chance the French government's going to fall this week. So that'll be fun. Give us something else to talk about, and various other things going on in the world. But I think the other interesting thing I saw recently was the Chinese have been out issuing dollar debt. That's an interesting bellwether. So got to ask yourself, what are they doing with it? They're filling a big hole back in China.
Yeah. Well, there's an interesting lineup of topics to talk about.
Sure.
I want to hear more of your thoughts on the Treasury Secretary pick of Scott Bessent, former macro hedge fund manager, I guess current macro hedge fund manager even. But just, it seemed like something Wall Street was very pleased with that pick. A lot of fund managers that I follow on Twitter had been quite vocal about why he's the guy. Just curious more of your thoughts on him. I know he's kind of put out this 3-3-3 plan. Yeah. What do you make of it?
Yes. Well, I think he's a solid pick. You want an adult at Treasury. Treasury is the most important agency in Washington. It's the operational heart of the government. And I think that, for better or for worse, he's kind of in that same mold as Steve Mnuchin. He knows what he's doing. He understands finance. And I think he has the right level of gravitas and just personal characteristics that he's going to be able to do the job. Trump is usually pretty good at picking smart people. And what you see him doing with the cabinet choices is he's picking people who are loyal to him. They're going to run policy out of the White House, by the way. So many of these people are going to be decorative. But that's okay. That's the way the government's been run lately. The Democrats did the same thing. So, when I saw Bessent, I said, good choice. The rest of them are either more or less political, depending on your tendencies. But I think it was, of all of the names that we saw, Kevin Warsh I liked a lot. I've always been a great admirer of his. I think he also could do the job. And then the rest of them, no, they weren't going to happen. Howard Lutnick from Cantor Fitzgerald, no. He ended up at the Commerce Department. He bumped that nice lady that wanted to be Commerce Secretary. So now she's going to do something else. The campaign director is running the White House as chief of staff. The kids are nowhere to be seen, which is good. So I think Trump is actually going to surprise people. It could be a lot less exciting than everyone hopes. There's a lot less drama. If anything, we're all waiting around for, second week in January so we can get this government in place.
A lot less exciting, but in a good way. Okay.
Yes. Well, we're all on the edge of a knife here because of the Treasury. Treasury is up to $37 trillion, in debt. And so, a lot of my friends have said to me, Chris, will Trump get a chance to put his agenda in place? Is the market going to give him that opportunity? Or could we see an equity sell-off and start things with a bang next year? So, the Fed is important here. There's other factors. But I think more than anything else, if Trump can make progress on the budget deficit and at least show that he's moving in the right direction, that'll be a big deal for him in the first year. And rates will fall, by the way, Julia. The Treasury is used to borrowing $1.5 trillion a year or more. So if you can start to cut that number down, rates will fall. You won't even have to talk about the Fed.
Okay, so interesting. So, Bessent, I know, wants to do something about the budget deficit. So what would you like to see accomplished from the Treasury? And you mentioned like rates falling. Let's also throw that in there as a consequence or an implication, maybe tease that out, what that could also mean.
Well, basically, you want to start to show the markets that you're taking the deficit seriously. We've had more than 4 years of what you can only describe as delusional behavior in Washington. Janet Yellen, the whole cast of characters in the Biden administration couldn't even say the word deficit. Their mouths would burst into flames. So, now you have a Republican government that wants to do things on a policy side. They also want to cut taxes. But if you're going to do all those things, you've got to show people that you're taking the government and the governance of the United States seriously, because we haven't been doing that. We're fortunate that things aren't any more dicey than they could be, given the financial situation, but stocks are up. Bonds are kind of going sideways. We got a 10-year that's still closer to 4.5 than 3.5. Remember where it was in September? We were writing 6, 5, and 7/8 mortgages in September. So the market's backed up 2 points. And I think, for better or for worse, Trump has to get up there and show people why they can be optimistic and why they should be bullish about the markets and about the U.S. economy.
Mm-hmm. Okay, so does the Fed really matter that much then when it comes to rates?
Not at the moment. Nothing bad's happening. They're still shrinking the balance sheet very slightly. I think the way I would put it is, you saw the other day that they dropped the rate on reverse repurchase agreements, which are essentially like T-bills that the Fed issues for money market funds and Fannie Mae and Freddie Mac. That is now at the bottom of their range. So what they're really saying to the market is, don't buy this paper, go buy T-bills. And they're trying to get the Fed out of the business of supporting specific areas of the market like money market funds, like banks, because when rates were at zero, they had a lot of entities that couldn't survive, including most money market funds. They couldn't make enough money on T-bills. So, now that we've wound that down to a point where it's getting very small, it's less than a couple $100 billion, what we're seeing is that the Fed wants to keep normalizing policy, and frankly, they would like to do less rather than more. So if we could slowly, say over the next 6 to 12 months, get Fed funds down to 4, thereabouts, maybe even a little lower, that's good. That'll help the street. You'll see more securities. You'll see more IPOs. The trouble is, I think the long end of the curve, because of the interest rates and the deficit and everything, is going to stay high. And so we could see 6.5% mortgages next summer. That's not going to make a lot of people happy, but that may be closer to quote unquote normal than we've seen in a decade, Julia. You and I have been talking about this for a long time. We've been through more than 15 years of extraordinary policy action by the Fed. So if the Fed could become less aggressive and less forward in terms of policy, if they could stand back and kind of let the other agencies engage, let Congress engage, I think it'd be a good thing for the economy and for the markets too.
Mm-hmm. Wait, so let me clarify. So long-term rates, those yields, they could rise.
Stay where they are.
And short-term could fall. Can you explain that divergence and can you help us understand what that would mean?
Well, look, when the Fed was saving the world, and this goes even before 2020, right? When they dropped the short-term rates, they were also buying long-dated securities. So they pushed the whole yield curve down. It was like Japan. Mm-hmm. So now, though, you're seeing a much more normal behavior on the part of the market where Fed wants to drop the target for Fed funds, fine, it'll go down, and everything after about 2 years in the Treasury market will follow. But then the rest of them don't. And particularly if you look at long-dated mortgage securities, the spreads between Treasuries and Fannie, Freddie, Ginnie are very wide. And what this is saying is that investors don't know how to price these securities. They're not sure, given the deficit, given some other factors, whether or not they should be aggressive about buying these securities. Banks haven't been. Banks really were net sellers most of this year. So that's kind of the context. And if you're looking for housing to help the economy next year, that's going to be tough. The mortgage bankers have already cut back their estimates for next year to about $2 trillion. We did $6 trillion during COVID, to give you some sense of the difference. This market today is all about people buying homes. There's almost no refinancing activity at all. So that's kind of the table. And I don't think the Fed or the Trump administration can do much to change that in the short term. The only thing Trump can do is if he can show the markets that he's getting serious about cutting back the deficit, long-term rates will fall. That's how you help housing. Get something going in the deficit. Get Congress to focus on the deficit, which they haven't done for many years.
Yeah. It's so interesting to explore this part of the economy, the housing bit, which I know that's your area of expertise.
The housing ghetto.
Well, I think we've talked in the past, maybe in a couple of years, a possible correction in housing, but don't expect housing to drive the economy by any means next year.
Yeah, no, some people are predicting a correction. They're too early.
Okay.
We're gonna see a little mini boom. Eventually, if the Fed has to drop short-term rates quickly, you'll see a rally in the long end. You could see the 10-year rally back down below 4% very easily. You can't fall asleep on this one, Julie, because it can go both ways. But having said all that, by 26, 27, my friend Stan Middleman at Freedom Mortgage says we get our correction, misery on the eights. And Stan's been right for 30 years, so I'm going to follow him.
Yeah. Well, we're going to have you on this program, hopefully in that time as well, monthly, so we'll stay up to date on that.
Yes.
Yeah, well, don't leave us because we love having you on. You mentioned that we're going to have to see Trump is going to have to show the market he's getting serious about cutting back the deficit. As someone who's been around for a while and watched politics play out, what do you think? Do you think we can see that? Can we be successful here? Are you optimistic?
Well, the bond vigilantes are back. And if the Congress tries to do what they've been doing for the past 8-10 years and just raise everything 10%, pass a continuing resolution, I think the markets could react very adversely to that. If people in the Trump administration think that we're going to take Fannie and Freddie out of conservatorship, they better keep interest rates stable. Because if not, then we're not going to get any of those things done.
Mm-hmm. Okay. Speaking of the GSEs, Fannie and Freddie, how realistic is that scenario that they could be taken out of conservatorship? I know this has come up before. I think in the first Trump 1.0 administration, I talked to the former CFO of Fannie at the time, Tim Howard, about this topic. But just curious, is this a realistic scenario?
It is, but lots of work needs to be done. We did a piece about it for the blog this morning. Essentially, you have to do three things. You have to first come up with a plan. If you're going to release Fannie and Freddie, and they are for the first time in their life, going back to the 1930s, going to be really private for the credit markets, what that means is that my friends at Moody's are going to downgrade them from AAA to AA. Now, do you think we can downgrade all of the Fannie Freddie residential and also multifamily securities out there? It's about $8 trillion. No. So Fannie and Freddie will have to pay Treasury to continue to wrap those securities with a AAA. What that means is that their business will change. And if they do, in fact, come out, if we hire a management team, if we get all the things done that need to happen before they are released, then they're going to end up competing with JP Morgan and Fannie Mae. It's not going to be the same business. They can buy loans, they can issue securities, but nobody cares about a AA rating, Julia, in the world of credit. You know that. If it's going to be out there with Fannie Freddie on it, it's got to be a AAA. So that, to me, is the big inflection point that's facing us. If you take them out of conservatorship and you want to pretend that they're private, okay, for the first time, then you're going to have changes in the business model. It's just the way it works. You can't get a AAA rating unless you're a sovereign. That's what the Moody's criteria says. I worked at Kroll. I ran corporates and financials there. And, the published criteria is the way this works. That's it. So I think a lot of people who remember the past, who are shareholders of the enterprises, maybe on the preferreds, they think we can go back to the way things were before 2008. And unfortunately, you can't go back.
I have a really dumb question. Okay, going from AAA to AA in the rating, how is that like a big deal?
It is significant for the bond market.
Okay.
In the bond market, value moves for ratings. So if you could imagine tomorrow morning, if Moody's came out and downgraded JP Morgan from a AA at the bank, not the parent company, but the bank, to a single A with no warning, what do you think would happen to their bonds? The spreads would widen. Yeah. In this case, what we're talking about is not just downgrading the issuers. There's two companies called Fannie and Freddie, right? They issue securities, they buy loans. That's their business. But they have $8 trillion worth of existing securities out there. And these are securities that are mostly treated as almost full faith and credit. They have a very low risk weight under Basel. So banks tend to buy these, pension funds, central banks around the world, all of that. You can't just downgrade those overnight because the spreads are going to widen and the price will go down. And you'll destroy the market for them.
People would lose a lot of money too.
They would lose money, and more importantly, they wouldn't want to buy them anymore. The prices would fall. So what I think we have to do is do the homework, grind the numbers, and say, if we take these guys out of conservatorship, given the way the market is today, the way the law is written today, many things have changed since 2008, as you know. Do we really want to do this? Because in order to get them out of conservatorship, we have to do this and this and this. And that's essentially what we wrote up. If you have trouble sleeping tonight, I'll send you a copy.
Okay. That's not true, Chris. Okay, let me ask you this. Because I remember, probably a decade ago, Bill Ackman comes to mind at Pershing Square. I remember he gave this as a trade idea, owning the stocks, like Fannie and Freddie stocks. I think there's a way to own them or somehow.
Yeah, they're penny stocks. They trade.
Okay. Do you own them by any chance?
No, I just watch.
Okay.
I write about them in the blog. They were probably the best performing mortgage stocks in the U.S. last year. They have continued to perform very well. But what I tell my readers is I say, look, this is a trade. This is not a destination. If you get a big gain in these shares, take it. They're going to trade off again because, we can't take them out of conservatorship for years. So the ebb and flow of the rumor mill and, the various firms that like to play in these stocks and write about them has been such that they've been quite volatile, the preferreds as well. So as long as you understand that this is a trade and that there's a low probability that either of these companies will ever leave government control, it's okay. I look at it kind of like crypto trading, but with more interesting stuff to talk about.
Yeah. I just remember anytime I would write about it, I would get a lot of emails or comments in the comment section.
Oh, yeah.
Yeah.
No, they do the same with me, but they're a little bit nicer to me because they know I'll bite their heads off if they misbehave on my
there
thread.
You go. Well,
I have a button on my desk. It says mute. And then we had the delete button right next to it. We try not to delete people too much.
Got it. Okay, let's go back to the Fed. One of the things I wrote down that you said at the top of this discussion was, if we do not get another rate cut this month, the whole narrative is going to have to be reworked. Can you expand a bit more on what you mean by that?
The street is a funny place, as you know. You've been doing this for a while. So the narrative that we developed back in August and September said multiple rate cuts this year, stocks go up, and bonds rally, right? Because remember, stocks and bonds have been positively correlated since 2008. That's not the way it's supposed to happen. But instead, what we saw was stocks did pretty well, especially after the election results came in, and the bond market backed up. Really from the end of September through October, past the election, the 10-year and longer dated securities have been backing up. So what I think we're seeing is that the markets are slowly starting to behave in a normal fashion. And if you don't see a rate cut in December, the street is going to be standing there kind of, looking at their shoes saying, well, what do we sell everybody now? What is our narrative for 2025? Because if they start going on about, 2 rate cuts in January, people aren't going to believe it. They have been promising a lot in terms of predictions about rate cuts, right? But the Fed has such a confused and somewhat contradictory group of data that they're looking at right now that they haven't been really strongly pushing for another cut. There are some governors, yes, who've said that, and there are others who've said they'd like to wait. So, as I said before, Powell likes consensus. He likes to find the middle point in the committee, which says, okay, we can all support a 25 basis point cut. I don't know that they're there yet. And that's what's so interesting. We could have some data come in later this month that may push them in that direction. But I think if you look at it today, in the first week in December, I'm not sure they really have a good catalyst for another quarter point.
Mm-hmm. Yeah, last time I think the last couple times they've been looking at like the labor side of things.
Yeah.
Okay. So
that's right. And it's not like there is a weakness in their economy. There is, but this is also a very, very dynamic, fully employed economy. Look at how poorly retailers did in earnings. Look at some of the more recent observations from the retail channel during Thanksgiving, Black Friday, and all the rest of it. Not particularly good, but it's hardly a recession. That's the funny thing I think we see, Julie, is there's so many data points out there that are not telling you one way or another. They're kind of in the middle.
Okay. Do we we haven't had a recession in a long time, it feels like.
Not a traditional recession.
Not a traditional,
no.
Yeah. Do we need one, you think, or could it be healthy?
We do, but the Fed is so terrified of deflation, and they are very, very afraid of what's going on in the commercial sector, commercial real estate, private equity. You have a lot of pockets out there where asset prices are quite weak. So if you saw a recession next year, you would see a sell-off in credit that would really impress people. Credit is kind of this little playground where people are throwing money at things they don't understand. But if you saw real default activity in terms of corporate bonds and also a further value destruction in commercial real estate, that would start to scare people, I think. Because remember, 15 years ago, 2008, when you and I were first talking, everyone was broke. It took years for this economy to pick itself up off the ground and have everybody kind of sort of behave in a normal fashion. Then we went through COVID. So we've had a couple of big shocks to the population. And I think in the back of everyone's mind, they're still worried that we may see another break like that. When the Treasury market freezed up in March of 2020, that was another sign to people that things are not quite right. Mm-hmm. So, this market is ready to sell off if given the opportunity. It's just that the Fed has been leaning the other way because they are afraid of deflation. They're still worried about Ben Bernanke in the 1930s at the end of the day.
Yeah. Okay. So you are reissuing your book next year, yes. Inflated, which came out, I think, was that a 2010 book?
Yes, it is.
Okay. So 15 years. Inflation today. I mean, also, is the Bitcoin narrative still inflation? Gold? I don't know. What is inflation still a problem?
Yeah, Bitcoin is my inflation indicator. When you see Bitcoin crawling up towards $100,000, that tells you inflation is still a problem. But I think, it's a structural problem. When people saw prices really galloping along over the past couple of years, and when vendors got a chance to catch up, they had all been absorbing price increases rather than passing it on to their customers. You saw the big shift in prices in food and other areas. And I think it was just human nature. They're trying to get it back. So, yes, it continues to be a problem. Inflation is the national pastime in America. One of the things about reviewing that book over the last year is that it reminds me just how many times the U.S. has gotten creative with money, really going back to colonial times and then obviously the Civil War. Lincoln paid for the Civil War. He paid for our redemption as a nation with inflation, and we continue to pay for it every day. So I think that, it is what it is. When you have a fiat currency and when you don't have a reference point like gold, then, obviously you have a vulnerability. And as time has gone on, the dollar is, this hegemon in the world economy, a little more than half of total usage in global commerce. But that's probably going to change. I think over the next couple of decades, you're going to see the dollar dip down. So it's maybe 40% of total global utilization. And you'll see a lot of other currencies out there competing with it. I end the book really by talking about why the U.S. economy and U.S. Treasury ought to be refocusing on gold. I think we should be exchanging paper for gold along with the Chinese. I'd like to see us issue gold coins. I've talked to Judy Shelton about that. I got a great Shelton quote at the end of the book. So,
can you give it to us?
She's a great lady. No, you got to wait for the book to come out.
Okay. I should have her on this program. I have not. I would love to have her.
Yeah, I'll introduce you.
That would be amazing. Okay, so you like gold then? Let's hear more there.
It's not that I want to see gold convertibility restored. You can't do that. That's the whole point of fiat currencies. But what you can do is give people a reference point for inflation. You can give them an easy way to protect themselves, even if they just want to buy gold coins. It's not a bad investment. And I think that to me, if Treasury was willing to do that, buy gold over in the broad markets and issue coins that are based on weight, not with a monetary value on them, but issue half ounce and ounce coins, that's going to give people a way to think about inflation that we haven't had since the 1930s. When FDR devalued the dollar and seized all the private gold in the country. That, to me, was much more significant than Nixon closing the gold window in 1971. What FDR did in the 30s was really quite heinous and didn't help. The U.S. economy did not recover until after World War II. So just about everything in the New Deal that the liberals tried really didn't have much effect.
Yeah. That's crazy to think that they actually
we talk about
seized the gold.
Tariffs too, the new popular topic of economic conversation.
Yeah, what's your take on tariffs? Would love to hear your take.
Tariffs in the 1800s were quite high. In fact, if you look at the period after the Civil War right up to World War I, they were quite high because we were protecting ourselves from the Europeans. The Europeans were quite happy to play the role of predator and use unfair trade practices. So I think, the U.S. paid for everything in the federal government with tariffs until the Great Depression. And, I would like to see, especially with respect to China, I think tariffs are totally appropriate because the Chinese are a modern mercantilist nation. They do not believe in equal trade. They do not believe in fair dealing. Everything they do is about putting advantage on their side and really hurting other nations. So until they're willing to change that, I think we have to treat them accordingly. The rest of the world, we got to be nice. I mean, the idea of starting a trade war with the Mexicans is silly. But on the other hand, I think the Mexicans need to accept the fact that the southern border of the United States is now Guatemala. It's not the Rio Grande. And they have to control what happens inside their own country. Same with the Canadians. They can't just leave their borders open and let people walk across anytime they want to. You can get in on the Canadian side quite easily. It's not a big deal. So, but when Trump says this, there's a lot of truth to what he says.
Yeah. One of the things I learned from Dr. Art Laffer is that Trump actually uses tariffs as more of a negotiation tactic.
It gets people's attention, yes. I think that's their primary impact. At the end of the day, if you put tariffs on China, is it going to affect prices in the U.S.? No, it'll affect their profit margins. Because they have such high margins on some of their products, they'll just absorb it. The Chinese are about market share. They don't really care about the individual prices. They care about controlling markets and building hegemony in certain industries, essentially to protect themselves. They are not a Western-style economy at all. So it's difficult to deal with them because they come from a different place. They don't accept any Western norms about free trade, or anything. It's all about, maximizing the benefit to China at the expense of other nations.
Mm-hmm. Okay, Chris, let me ask you about the Department of Governmental Efficiency from Vivek Ramaswamy and Elon Musk. What are your thoughts there, and are you hopeful?
I think they will make a lot of noise. I'm not sure what the Congress is willing to do. Elon Musk said that we should get rid of the Consumer Financial Protection Bureau, which I think everybody in the housing industry would agree with. Are the Republicans going to do it? No, because there are certain members of the House that have become comfortable with the CFPB and they kind of like it for a variety of reasons. So there's going to be a lot of talk, but are they going to get rid of the Department of Education or the Department of Energy? Probably not. I think it's more rhetorical than anything else because, the Congress is totally dysfunctional, Julia. The Senate can't even mark up a budget. They have many, many other things they have to do, as you know. So, the House is not much better. The House is really going to lead the parade under Trump, I think, in terms of policy changes. But who knows? We may get some things done. I just wouldn't hold out much hope for Mr. Musk and his crusade. I think it's going to be mostly about the media.
Well, but maybe, how about like some transparency into some of these things? I feel like maybe air it out or shine some light on it even.
Well, they are going to do big headcount reductions in federal agencies. That's clear, because that's an easy way to save money. They are also going to be rooting out what they, claim to be progressive elements who are hiding under the guise of civil service in these agencies. So you're going to see enormous numbers of people who are involved in policy now, essentially being forced to leave. Other than that, though, I'm not sure how much more they're going to get done. So little of what is discretionary in the government really impacts the numbers. Most of it's entitlements and defense. So unless you're willing to cut there, and who knows, maybe Mr. Musk can save us some money.
On defense, probably, yeah.
Yeah, he understands the game there. So, could be. He's a very smart man. But we need to show progress. We need to get numbers smaller on the deficit. And then you start to reap some rewards. So if you're Trump, you probably got to focus on the deficit first, and then maybe hold out the prospect of either renewing or extending some of his tax cuts.
Mm-hmm. Well, it's interesting, too, like on the headcount reduction bit, a lot of the job creation has come from like government jobs too. And, it's government spending as well is a big portion of the GDP. So I wonder like how maybe there's a fine line to walk there as well.
Yeah, it was just politics. The Democrats always do that, going back to Tammany Hall. Headcount increases before elections are a tradition in America, but it didn't help them very much, did it? The private sector is where you get things done. The public sector is just a consumer of resources.
That is true. That's one thing I've learned is that the public sector, it can be quite contractionary over the long term, and the private sector is where the real growth comes from.
Well, look here in New York. I mean, the public sector unions and the Democrats are in this love embrace. The city is slowly chasing the business community out. So all we're going to have is housing and healthcare services to support the economy. That's not going to work. You have to have a vibrant business community to pay for all of this stuff. And that's the real lesson. Even down south, you go to some of the big cities like Cincinnati or Dallas or Atlanta, downtowns are pretty empty. You can have as many buildings as you want.
Yeah. Yeah. I'm sitting in New York right now, and it's not the New York that I left.
No, it's not, is it? Mostly tourists?
No. I have not been on the subway since probably like March of 2020. Yeah.
Well, it has gotten better, but it doesn't really attract me, to be honest with you.
Yeah. I'm kind of a fraidy cat. Okay. What would you like to see accomplished from the Trump administration? What would you like to see?
Well, if we can simply get a handle on fiscal issues and start governing better. We haven't had any governance in Washington in a long time. I think those are two of the key things. Try and refocus both Congress and the institutional government on just getting things done. We don't need headlines. We don't need press releases. It's just really a matter of blocking and tackling and policy. I think Trump understands this. He knows now that you got to put people in positions and get them confirmed by the Senate before they can make policy. That's the requirement. So I think you're going to see a very, very strong focus on getting appointments done in the first 6 months and then getting on with things. And they will immediately be focused on the midterm election because I know they want to expand the Republican majority in the House.
Well, Chris, it is always a pleasure having you on. We love having you on every single month. Would love to do this in person at some point. Any parting thoughts, any final words for the audience, maybe something that you want to reinforce from this conversation or things that we didn't bring up in this episode?
Well, I think the one thing I'm watching is I usually watch very closely is just the Treasury auctions. We got to make sure that this market doesn't start to get unstable before inaugural day because, there's been nobody watching the store under Janet Yellen. She's been off talking about global warming and various other things, but really hasn't been focused on finance. And I think between the Fed and the Treasury, they've done more than enough to be helpful. And now it would be nice if they kind of got out of the way and we can just see what this private economy is capable of doing. I think Americans would like less volatility. Whether you talk to business people or consumers, they really don't want to see things change, and they don't want to see prices change at the grocery store every time they walk in. That's what bothers people and makes them afraid. So I think that's what we would like. Let's be boring for a while. We don't want stocks to be too boring, but the rest of it can be boring.
I like boring and more affordable, please. It's crazy out there. Yes. Well, Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst. It is always a pleasure having you on. We love having you every month. Thanks again, Chris.
Thank you, Julia.